What's going on? Jason Soroy here with Compass Denver. Today we're talking about the market update, the market data, Q1 versus Q2. However, we're doing it a little bit differently. We're looking back over the difference between Q1 and Q2 over the last 5 years. So I've done this a little bit different than the traditional monthly market updates, which you might be familiar with. What I've done now is I've actually gone directly into the MLS, exported the data for the KPIs that I'm most interested in, including close to list price ratio, days in the MLS, average sale price, and active listings. And I wanted to look at, hey, what does this look like Q1, Jan, Feb, March versus Q2, April, May, June, and drawing out any conclusions or trends that might be useful for us to look at so we can continue to make smart real estate decisions. I look at this all the time and I just never recorded it quite in this way. So you're going to get a little bit of a peek behind the curtain here. So I find it important to go high level every now and again. And I mean, really, it's quarterly for me. So I want to know, instead of going month over month and just looking at the year over year trends, which is very useful, don't get me wrong. I like to just look at this aggregated 3-month chunks of rolling data so that we can see at a higher level, where's the market going? Where are we today? So that we can point ourselves in the right direction and make the best predictions we can with the information that we have. So this information, I will also say, is whittled down to the geography of the front range. So I am a fan of looking at data that is as accurate as possible to the area where I work, which is the 6 metro counties of the Denver Metro: Adams, Arapahoe, Broomfield, Denver, Douglas, and Jefferson County. So those 6 metro counties represent the majority of the front range of the Denver Metro. I'm not talking about Summit County. I'm not talking about Boulder County. There's going to be some outlier properties in some of these areas that DMAR will report. So without further ado, let's dive right into the data. So let's get started right away. This is close price to list price ratio, Q1 versus Q2 for the Denver Metro 6 county. And this includes both the attached and the detached single family market. I have not separated these out, which I do below for average sale price, but we'll get into that in here in a little bit. So close price to list price ratio is an important metric because it helps us understand buyer enthusiasm, buyer velocity, and how much over list price people are closing on homes for. So we're going to be taking a little bit of a trip through time here. So we're going to be looking at 2019 and 20, 21 and 22 are our COVID years. And then the last 12 months, 23 and 24 are kind of really showing some trends very similar to what we saw back in 19 and 20. So first of all, I want to say that it's not a surprise rather, to see that we see an increase in close price to list price ratio as we move from the winter time into early spring. The early buyers really start to get going around February, and those folks are likely to close in March or April. So it's not a surprise to see that we have just under 100% for our Q1, which is all the blue bars here. And of course, we will probably see that number come in higher. Again, it's the ratio. What does a seller want and what is a buyer willing to pay? If it's Q1, you're probably going to be able to get a little bit more of a deal because A, there's fewer homes available for buyers to choose from, and therefore there are fewer buyers shopping. Buyers, if you're looking to pay a little bit less than list price, Q4 and Q1 are good places to do that. But I want to point something out here. Let's look at the middle of this chart. This is 21 and 22. We are deep in COVID during those years. And this is when interest rates are low, inventory is low, there's a buying frenzy, everybody is trying to get more space. It is quite unusual to see these numbers: 104% close to list in 21 and 103.9% close to list in 22. This was a frenzied time. And, because interest rates are low, money is cheap. It wasn't that far in the rearview mirror. Everybody knows about this. Last 2 years, 23 and 24, almost mirror perfectly what we saw in 19 and 20. And by the way, 2020, this was pre-COVID because this is January, February, March, April, May, June. So there was some COVID in here, but it was just the tail end of it, considering when somebody starts the search, they're probably not going to close for about 30 to 40 days later. So fast forward to exactly where we are now. Q1 of this year, we're at 99.7%. Q2, we're at 100% close to list price. So this goes to show sellers that if you list your home for an appropriate price that is vaguely within reason, you're probably going to get an appropriate offer for list price. Again, this is aggregated data, both attached and detached. There are nuances there based on neighborhood, based on the condition of the home, obviously, and the size of the home. So it's nice to see that we are actually in a more stable environment, I would say, thinking that these are going to be our outlier COVID years. Great. Moving on, we're going to be talking about days on market. This is another key performance indicator, KPI, that we like to use because it helps us understand buyer demand, just like close to list price ratio. So you'll notice bars and lines here. I wanted to include both the median and the average in the same chart. So what I did here, the blue bar is Q1 average, red is Q2 average, yellow is Q1 median, and then green is Q2 median. So as I'm explaining that, just keep that in mind. So we see almost an identical trend here where we have this anomaly in 21 and 22 versus almost back to, I would say, normal, however, tipped in the other direction. Allow me to elaborate. We have seen interest rates quite high since the first week of June of 2022. As a result, buyers have pumped the brakes, not entirely, but they have slowed things down. There's no longer this frenzy because money is no longer cheap. And frankly, we have an affordability issue nationwide. Prices are high, interest rates are high, therefore payment is exponentially higher. So with an affordability problem, you're likely to see more days on market because you have fewer enthusiastic buyers shopping for a house. So we are well above our pre-pandemic levels for days on market on average and median. So look at this. We're at 45 days on market for all of Q1 2024. And similarly, just like close to list price ratio, it's not unusual to see this dip as we get into the spring months. So March, April, and May, or yeah, April, May, June for Q2, of course. It's not uncommon to see this dip, but the size of the dip is what's important, and also how high do these bars go. So this is a key indicator that the market has shifted. We are at more days on market on average than we were pre-pandemic levels. And that I blame interest rates. We had a lack of inventory due to this lock-in effect where sellers really weren't too enthusiastic to put their home on the market because they didn't want to give up their 2.9 or 3.0% interest rate in exchange for 7. And that leads back to the affordability issue. What I predict will happen if we see interest rates come down later this year, which some are saying we will, I'm saying I have no idea. There's too many unknown factors and I'm not in the game of predicting interest rates. But if rates do come down, we will see these days on market figures come way down because buyers that are on the sideline will enter the game. Moving on. All right, let's talk about average sale price. Now I like to separate this one out, single family and attached. Attached is going to be condos and townhomes. You have at least one shared wall. So right now we're just going to talk about this lane of single family only, again, 6 county. So we peaked with our average sale price, 805,943 for single family homes in Q2 of 22. Right after that is when the interest rate spiked. It was the inflation control mechanism that the Fed has not released their grip on because inflation has not yet hit the targeted 2.0, not 2.2, not 2.1. We have not hit 2.0 inflation. And until we hit that, we're not going to see interest rates come down. Jerome Powell has made that quite clear. So this is interesting. This is kind of the tail end of the low interest rate game where we saw money was cheap, prices spiked. So I want you to follow kind of my mouse in the curve here. So if you take a look, it's a little bit flat, 2019 to 20, and then boom, we have this steep, steady incline of average sale price. And then we have leveled out and then actually dipped a bit in 2023 from Q2 of 22 to Q2 of 23. We have this delta here. We're sliding back. We're depreciating a bit. However, we have since made up pretty much all of that ground. We're just like $3,000 away, 3,300, I suppose. So we're right here. We're going to pop just up a little bit more. And we are right back at this average sale price that is almost equal to the peak of 2022. Now, this is interesting to me because there's this relationship between supply and demand. And of course, there's this element of affordability that has to be considered. And affordability sucks right now. I'm recording this on July 8th, 2024, and affordability is garbage. What people want and what people can afford are two very different things, and people are fed up. However, because we have had not as much great inventory, quality inventory where size, location, and condition all align, those homes are still seeing multiple offers despite this high interest rate environment. So that factor that there are very few nice homes on the market where the most desirable areas are, that is keeping prices inflated and held up with quite a lot of stability. So it'll be very interesting to see when interest rates come down, what does that typically do? Prices go up. This is going to be, I think, a market that is very much at the mercy of interest rates. I am not going to predict what interest rates are going to do, but I will say if they come down, we're going to see prices go up and demand will surge. And if they stay high, probably going to see things level out, and maybe month over month, we'll see a little bit of a pop up or a little bit of a decline in appreciation, but time will tell. Let's move on and take a look at the attached single family market. This is probably the most interesting chart to me, and I'll tell you why. You'll notice that we see an increase from 2019, from Q1 to Q2, increase, all the way to 2023. Folks, we have seen a decrease in the average sale price of attached single family homes from the end of Q1 24 to the end of Q2 24. This is significant because look, this is a 5-year look back. We have not seen a depreciation. Granted, that number is very small. We're looking at, 0.5% is the percent change. However, this is worth noting. Now, through conversations with fellow brokers in my office and other brokerages, condos are struggling right now. There's been a lot of discussion, a lot of change to HOAs. There's been a lot of turmoil in the insurance industry. So a lot of insurance companies are either raising their deductible requirements for a lot of these wind and hail prone areas like the Denver metro. So some of these condo buildings are seeing increased HOA dues to cover this new deductible increase, and it's causing more strain on the affordability issue that we are already seeing. So if you know a friend with a condo, maybe reach out to them and ask them how they're doing, because there's a good chance if they're trying to sell their home, it's not moving as quickly as they'd like, and they are even maybe losing a little bit of value, and nobody likes it when that happens. So could that be a buyer's opportunity? Potentially. And if you want to talk more about that, you know how to get in touch with me. So very interesting, slight decline here. And by the way, let's look at where we are down from 493,772 was our average for the attached market. We're down to 466 in the townhome and the condo market. So we have slid back for 1-2 years in a row now. So reach out to your friends with condos. They might need a drink or something. Next, active listings. I'm a fan of this metric. Obviously, this tells us supply. What is our supply? Moving on. And this reminds me of one of those childhood projects where you paint something and you fold the paper in half, and then you open it up and you're like, oh my gosh, look at this cool shape. It's symmetrical. So just me. Okay. Yeah. That was a weird tangent, but it's almost perfect, right? Look at this. Pre-pandemic, 8412, fast forward to 2024, 8827. Our inventory has surpassed that of pre-pandemic levels. But if you look at the pandemic right here, 21 and 22, this is a similar story we've been talking about. This was just incredibly low supply, fueled by incredibly high demand and low interest rates, and a flock towards more space. So these are the COVID times. And now that we've climbed out of COVID, some would argue we're seeing more balance. Some might also argue that we are seeing a shift. And I think depending on how large or small your data set is, both of those are true. So we are noticing a shift away from sellers controlling all the leverage in a transaction to the buyers having quite a bit more. However, there are anomalies to this. Just last month, and I don't want to get too micro specific on one data point, but we had 7 offers on a $350,000 townhome near Old Town Arvada, and we closed for $19,500 over list price. We did not list it too low. We listed it fairly. So homes that are staged appropriately in good areas, present well, don't have a lot of projects for buyers to take on when they move in, those homes are still going quick. It's a very fickle market. It depends on many factors. And now more than ever, it's important to have a great advisor before you hit the market, because you get one first impression and you don't want to mess that up as a seller. Buyers, what this means for you, you have more homes to choose from. We haven't seen an 8,000 count on average since 2019. More homes to choose from is a good thing, but more good homes to choose from might be a different story. So interesting information here regarding active listings. Again, I am Jason Soroy. I'm with Compass Denver. And if you have any questions about the real estate market, or you'd like to talk more about your specific situation, feel free to give us a shout. Our contact information can be found quite easily online, but down below. I hope you're doing well, and I hope you found this helpful. If you have any other specific questions about the data, I love the data. Let me know. I'd love to help you out. What questions do you have? What information would you like to know more of? Get in touch with us. Much love. Thank you for watching. Be well. Take care.